This is Tim Phillips, Chief Investment Officer at Phillips and Company Advisors. I'd like to thank you for taking the time to review our Q1 2024 look ahead. All of us at Phillips and Company hope you have a healthy, happy, and prosperous 2024. Please read all the disclosures carefully. In very typical Wall Street fashion, big Wall Street banks made some very precise predictions about 2023 and once again proved wildly wrong. Now, as investors, we love the precision of these predictions and generally forget they're mostly inaccurate. Wall Street missed the mark again by almost 300% when you look at S&P 500 returns. And again, they're off on their GDP forecast by almost 1,500% when they predicted almost no GDP growth last year, and yet the economy grew near 5%. It's almost useless to view 2023 forecasts because generally they're going to be wrong, but you can see Wall Street analysts expect a very flat year for the S&P 500 in 2024. The consumer is down but not out. And let's just start with them as they represent the lion's share of our economic growth. Their wage growth has been moderating and employees have been staying put in their jobs versus jumping around for higher wages. However, the consumer is starting to feel some of that strain from higher interest rates, with consumer credit default rates ticking up. And while it does look like they have some excess savings still, most of that's really embedded in upper income earners, and they're unlikely to drive much of that future consumption in the macroeconomy. The consumer does have plenty of debt service capacity left, but it's in my opinion they're unlikely they'll tap into that with interest payments on credit cards as high as 25%. The consumer is in a really precarious point in this part of the economic cycle. It's finally here, transitory inflation. The latest print on consumer prices shows inflation moving rapidly towards the Fed's target of 2%, and you can see that on the upper left. In fact, goods inflation in the red bar is near zero, and perhaps it's even deflationary. And when you look at housing as the largest part of consumer inflation, it's starting to moderate as well. In fact, when you subtract out that component, housing, along with food and energy, you can see inflation down over 50% from peak from not too long ago. This is the exact setup we need for the Fed to cut rates in 2024. The Fed is going to cut rates in 2024. There seems to be no dispute to that. Federal Reserve interest rate forecasts are divergent from what futures markets are anticipating. The Fed suggesting 3 rate cuts next year of about 75 basis points. Futures markets suggest 6 rate cuts next year of about 1.5%. That's that shaded green area in the chart on the upper left. That divergence suggests some real differences between the Fed's economic forecasts and those of investors. The Fed's forecasting about 2.6% GDP growth, moderating inflation, and only a slight bump in unemployment. However, historically, it takes a rapid rise in unemployment to get inflation to moderate and thus see rapid rate cuts. And you can see that in the upper right. Currently, we're in that green circle area, but historically, inflation moderates in that red box. And again, that's typically what we see is rapid rate cuts if history's any guide. We don't usually see a smooth landing like the Fed's forecasting with their interest rate cut projections. The question is, for investors, is there trouble out there in the economy we don't see? Is there a rapid rise in unemployment going to occur? Is there an unexpected credit crisis? Those are the things we're going to have to keep our eye out in 2024. Let's put a placeholder on the macroeconomic picture and focus on S&P 500 earnings. 2024 looks to be a very strong year for corporate earnings. maybe simply by way of very poor 2023 earnings. The base effect is going to be in our favor coming into 2024. Now, while valuations are high, earnings growth could be the driver for more equity returns in the year. Certainly, the flood of money coming out of money markets will be an additional boost to equities when interest rates do get cut, maybe to the tune of as much as 5% of the S&P 500's total market cap. In fact, the average return on the S&P 500 is about 37% during rate cut cycles. Fixed income looks to be a win-win for portfolios. With synchronized global rates being cut in 2024, longer duration fixed income and treasuries should benefit. Further, those rate cuts will stimulate a drop in money market returns, and in all likelihood, investors will push money into equities and longer duration fixed income. And you can see the yield curve flattening. That's the blue line in the upper right-hand chart in just the last 2 months. Now, we've added duration portfolios over the last couple months, and you'll likely see those in your returns. In the lower right-hand side, you can see a host of returns for fixed income, and especially the 20-year long duration we've used, that's been richly rewarded. It's really been a win-win for both equities and fixed income when rates are anticipated to be cut, and we expect that at least through Q1 2024. Developed markets might be a decent tilt for 2024, and I don't say that lightly, as we've been mostly underweight those markets like Japan, Europe, Canada, Australia. However, strong earnings growth combined with lower valuations lead us to believe we might move a little closer to target weightings as we see a recovery in those economies along with rate cuts later in the year. Emerging markets should benefit from U.S. and global interest rate cuts. It's been a slog for emerging market returns, but 2024 could be a pivot year. China's at a cyclical bottom, and since they make up nearly 30% of emerging market index, any recovery will be magnified. Earnings growth should be similar to developed markets, while valuations are at a 42% discount to U.S. valuations. So our sense is we'll likely move to portfolio weightings in emerging markets versus the slight overweight we've carried in the past couple of years. From time to time, I like to remind our clients that it's a world of chaos out there. Wars, competing fiscal and monetary policy, transit bottlenecks, you name it, we've seen it and will likely continue to see it in 2024. Let's not forget that over 40 national elections are going to take place across the globe in 2024. Certainly, that suggests there's going to be lots of volatility. In fact, drawdowns in equity investing are normal. We spend about 71% of the time in a drawdown. That's especially meaningful since we're walking into 2024 at near all-time highs. In just my career, I've seen pretty tough times, and yet the Dow Jones is up 26-fold in spite of wars, recessions, massive drawdowns, pandemics, and it's just impossible to try and time these things. While I spoke earlier of something lurking in the economy we don't know, we also know if we have the right time horizon, equity investing has always paid off. In fact, take a look at the video from our friend Morgan Housel, who's our best-selling author, in the link below to know more about investing in a world of chaos. I absolutely don't want to leave you with a dark taste in your mouth about 2024. In fact, I'm quite optimistic, especially in election years. Again, if history is any guide, you can see some pretty nice returns, both in election years and while there are rate cut cycles. We just happen to have two bullets coming at once. Equity returns are strong if we can avoid a recession, and fixed income returns can also be strong during rate cut periods. 2024 is setting up to be a collision of positive forces for investors. As you look at our mean reversion dashboard, you can see some small opportunities in U.S. small and mid cap, both on the value side and small cap, particularly on the growth side. In terms of countries, developed markets look reasonably priced along with China and Brazil, India being the most overvalued. Areas like energy and real estate will certainly benefit from more rate cuts in the coming year. Our views and recommendations are pretty straightforward. The Fed's going to cut rates in 2024 between 3 and 6 times, depending upon the severity of any economic slowdown. I'd expect those cuts to be done by mid Q3 to avoid the Fed looking too political in nature as we roll into an election cycle this next year. Developed and emerging markets will benefit from those rate cuts, and that's why we'd like to maintain equal and slight overweights in those markets. We'd like to overweight U.S. small and mid cap based on the valuations you saw on the prior slide. And we'd like to hold a slight overweight in emerging markets. Thank you for taking the time to review our Q1 2024 look ahead. If you have any questions, please connect directly with your advisor. And of course, you can email me directly with the email address listed on this page. We wish you a healthy, happy, and prosperous 2024.